Ding, ding, ding. The market is closed, and now we wait. What do we wait for? We wait for the CPI read that we get tomorrow. Why is this particularly important? Well, in order for the market to rally and the bullish case many have been able to grab onto, we need to see signs that inflation has peaked or is in the process of peaking. Many seem to be concerned, and in the last hour or so of trading, fearful and deciding to panic sell. And that's why we saw the aggressive move into the close today. In my opinion, that's a good thing. As we've talked about in the past videos recently, we want to take the stairs up for all the reasons that are mentioned. We don't want a flood of buyers and then for there to be an air pocket. We want a lot of congestion. We want back and forth, and we're seeing that today. We're seeing that in the stock market. However, the bond market is telling us not the opposite message that the stock market's telling us. First of all, the 30-year bond auction had an incredible auction. So there's a lot of demand for US debt. People know what's happening with inflation. If they're concerned about inflation, it's unlikely they're going to go in and buy 30-year bonds. If they're concerned about the future of the United States, unlikely they're going to take that kind of long-term risk, etc., etc., etc. So hopefully we see something good with inflation tomorrow. But in addition, we saw a rally in 20-year treasuries today, and 20-year treasuries are the highest yielding treasuries. So I think these are all good things. Obviously, it's unknown until the number comes out. But as far as I'm aware, we have already peaked in inflation in what matters, and that's the month-over-month read. The last month-over-month read came at 0.3%. The read over that, 0.4%. So we're seeing a tick down in that. It was, I believe, 0.5 or even higher than that month-over-month. The month before 0.4, but 0.4, 0.3. If you annualize 0.3, that's 3.6% inflation. So if we stayed at last month's rate, we should expect next year to see somewhere around 3.6% inflation. That's not a crazy number. However, if the trend continues, it's possible we get 0.2 tomorrow. 0.2 annualized is 2.4%. That's closer to where the Fed wants to go. Now, I'm not saying get bullish because tomorrow we're going to get 0.2 and the Fed's going to pivot. If we get 0.2% month on month, the Fed's not going to stop. If we get zero increase month on month, that would be fantastic news, but the Fed is still not going to stop. They're not going to stop. We don't want them to stop yet. We want to get the situation under control, get inflation flat, possibly even tick down. I think we'd be cool with a little bit of a tick down, depending on what stocks you have, etc. They want to have a strong grasp on the situation. We're starting to see indications that it's going their way. It's going in the inflation peaked way type situation, but it's still too early. So I'm not trying to say, we're not getting 250s. I'm not saying, September pause. 50s are still on the table, but if we see inflation peak, that bodes well for the future path of the Fed, future path of the economy, etc. So I think the bond market is giving us better signs than the stock market. The stock market seems to be having a little bit of an emotional reaction. Last hour, just panic sell, panic dump. Seems like everyone who wanted to buy, the same phenomenon we talk about, people wanting to sell. They don't want to be the last one to sell. They want to think they're ahead of the game and selling early. So I think people bought early. Today is kind of like the last day. Nobody wants to be the last buyer. So here we go. There's an absence of buyers today. Last hour, there's a panic sell. Oh shoot, we got a nice rally here. If CPI comes in where it should come in, it's probably a good idea to sell. People are selling. No last minute buyer because they don't want to be the last ones. Could be a good setup for what happens tomorrow. So let's see what happens tomorrow. CPI read. Now we wait. Tomorrow's a moment of truth. We're going to have to adapt one way or the other tomorrow with that data. So one last thing that I want to mention. Don't want to get over bullish or anything, but it's just an important thing to know and to consider. The Fed's favorite tool is not CPI. CPI includes gas prices, food prices. As far as I'm aware and what I can see, the biggest increase in cost right now is energy. And that's a cyclical business. Has a lot more to do with whether or not the Fed is printing money. I don't think the Fed printing money affect energy prices. I mean, maybe it does historically, but right now it seems to be an underinvestment in additional supply. The world's growing, we're using more cars, we're buying bigger cars, etc., more planes, etc., etc., etc. People stopped investing to keep up with that growth, and now here we are. So the Fed is not looking at that. And I think when they take that out and look at the PCE inflation, they might see what they want to see, which is, Target unloading inventories into the market at discounts, et cetera, et cetera, et cetera. Some consumer slowdowns, not aggressive wage hikes. Like, we're seeing the signs of peaking inflation. So don't read into too much of today's price action. We talked about that kind of stuff yesterday's video. We acknowledge the potential for a pullback. Looks like we got a little bit of something today. We think that's a good thing. Hopefully we get some good data tomorrow and everything is going perfectly to plan, or at least our hopes. So we'll see what happens. That's today's video, and until next time, peace out.